Investing in stocks is a great way to build long-term wealth. You might be shocked to find that a $10,000 investment made in the S&P 500 index fund 50 years ago is now almost worth $1.2 million. Beginning in the stock market might be intimidating for newcomers and cause anxiety. Here are 3 key elements you should think of before investing in stocks. First, which stage are you in? Stage 1. Wealth building stage. Stage 2. Wealth preserving stage. Stage 3. A combination of both Stage 1 and Stage 2. Second, what degree of risk is acceptable to you? There will always be risk inside the stock market. Third, are your investments long-term or short-term? Watch our video, Stock Basics for Beginners, for a thorough knowledge of all these elements. Let's get started with some beginning stock market investing in 4 simple steps. Number 1. Create a brokerage account. You need to open a standard brokerage account with a company. The companies that offer brokerage accounts are different from the regular companies that offer stocks. It is an account where you can log in to access and manage your investments. The company will probably ask you if you want a cash account or a margin account when you open an brokerage account. For many investors, a cash account is suitable. It allows you to buy investments with the money you deposited in the brokerage account. You must be at least 18 years of age and have a social security number in order to open a brokerage account. Several online brokers don't charge fees. They don't even require a minimum amount. You can begin investing after your funds are in the brokerage account. If you are not sure which company to pick, watch our video, Top Brokerage Account Picks for Beginners. Other brokers allow buyers to purchase fractional shares. Meaning, you don't have to buy the whole share. If TLSA's entire share price is $760, you can purchase a portion of it for $76. Wait till the end for where we share few beginners' tips. Number 2. Determine your investment strategy. There are 3 ways you can choose to invest. Number 1. The DIY technique. Those who want to research and analyze should go with the self-managed strategy. The good news is it is easier. You can dominate your investments with minimal effort. The key is to keep it simple. 80 to 90% of the time, index-based investment strategies beat actively managed investment strategies. Number 2. Let someone else manage it for you. A human specialist can assist you if you are new to investing and require professional guidance to get started. Keep in mind the breathtaking expense ratios on the funds they select for you. Number 3. Robotic advisor. Robotic platforms, or robo-advisors, assist you in creating and managing your assets. This is less expensive than hiring a human expert. You can build up an investment strategy and delegate the rest to the robo-advisor. Step 3. Decide what type of stocks to invest in. There are 3 categories of stocks you can invest in. 1. Exchange-traded funds or stock mutual funds. Mutual funds let you purchase a bunch of stocks in a single transaction. When you invest in any of the mutual funds, you own a small portion of the companies in that mutual fund. The upside of mutual funds is that they are diversified. The downside is that are unlikely to have a meteoric rise like the individual stocks. 2. Individual stocks. These require extensive research. A company's shares can be purchased in single or multiples. If you choose this path, keep in mind that each company has its ups and downs, thus there is a downside. The benefit of buying a single stock is that you may profit handsomely if you make a great choice. 3. Combination. This is a popular choice of many people. People build a portfolio of individual stocks and mutual funds. They both don't have to be in the same brokerage account. It's not necessary for them to maintain separate brokerage accounts. Please subscribe to our channel before I continue to encourage us to create additional material. Step 4. Estimate your investment capacity. Set a budget aside. If you want to buy an individual stock, it depends on how expensive the share are. If you did a research and want to buy a share but cannot afford it, you can buy a fractional share. If you want to buy a mutual fund and your budget does not allow you to do so, go for an exchange-traded fund, also called an ETF. There aren't many people looking to make quick money. Here are a few tips before you get started. Investment in stocks is beneficial for long-term wealth. Stock investment is good for long-term investors. Get your emotions in check. Don't panic when the market falls. Don't let your emotions rule you. When stock prices decline, investors should be pleased since it is now more affordable for them to purchase additional shares. The rewards will be higher the more affordable the stock price is. Increase portfolio diversity. You can invest in a variety of industries: food, travel, hospitality, gaming, social media and wine. CJ Column quoted, "I'm just trying to diversify my portfolio and put myself in a position so when I do retire, the options are limitless." Learn the fundamentals, including price-to-earning ratio, return on equity, and expense ratio. If you like the video, please like and share it to encourage us. This concludes our discussion of stock investing for beginners in today's video. Watch our video on stocks fundamentals for beginners if you want to understand the fundamentals.